Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague Kristian Kerr this week to talk about the exciting world of global bonds. How are you, Kristian?
Very well. Good to be here, not on a Thursday with you, Jeff.
Yes, we normally do our internal call Thursday, so nice to talk to you on a different day. It's Monday, September 15th, 2025, as we're recording this. Monday afternoon, another up day. The equity optimist will say, you know what, this market just keeps going up, but we're going to talk bonds this week, Kristian. So we need to be a little bit more balanced or measured. How about that?
That's fair.
We won't bring the doom and gloom because it's not quite that bad. But certainly the rise in international bond yields is noteworthy. And certainly I don't know, is it too much to call it political turmoil in some of these foreign countries? Maybe that's a little too strong. But certainly we have a lot of political uncertainty, and that is affecting markets. So we'll spend most of the time talking about that this week. Of course, as we always do, we'll start with a market recap, and then we'll do a Fed preview at the end. Of course, this is Fed week. Unless you're living under a rock, you know this is Fed week, and that'll certainly be the focus of markets this week, particularly on Wednesday. So in terms of the recap, it was another up week. This market just keeps defying the skeptics and goes higher. I think there were two reasons. I just mentioned the Fed was one. So, Kristian, we had anticipation of Fed rate cuts. Basically, the data almost guarantees, we'll say, almost guarantees the rate cut. And so obviously equity markets like that. But then you also had this absolute blowout in terms of Oracle's guidance on AI data center revenue. And I think those were really the two biggest stories last week pushing us higher.
Yeah, I agree. I mean, I look at some of these AI baskets, and they had their second biggest, one day advance in 5 years following the Oracle
Wow.
announcement. I saw hedge funds, they were buying tech stocks at the fastest pace in 7+ months last week. So clearly, kind of that Oracle news got the focus back on the AI trade. Bears might say maybe this is a crescendo moment. We'll see. So far, not playing out that way. But other than that, I mean, I think being a macro guy, the kind of the more interesting thing for me is at a macro level, there's a clear growing divergence in the narratives driving the equity market and the bond market. The bond market, I think, is focused on these signs of a cooling labor market, really interpreting recent data as being indicative of broader potential slowdown. That's led to kind of increased expectations for more policy easing and just a more cautious outlook on growth. But then on the other hand, you've got stocks, and they're just looking through the near-term weakness in the employment data. They're wanting to focus more on this potential cyclical reacceleration early next year. I think they think that could be catalyzed by kind of the support of monetary policy, and maybe some fiscal as well. So kind of the multiple rate cuts, maybe some stimulus impact from the OBBA. And really, it's like, for me, this disconnect really suggests that investors are in each of these asset classes are really prioritizing different elements of the macro landscape right now. The bond guys are focused on the downside risk. The equity investors leading into this idea that policy support will reignite growth and earnings momentum. And I don't think both narratives can be correct, at least in terms of sequencing and trajectory. Either the slowdown in the labor market will prove more persistent and drag on the broader economy, forcing equities to reprice, or vice versa. We kind of get this slowdown not being as aggressive as maybe the bond market thinks. So I think over the next few months, that's going to be kind of the big theme that plays out. Which one of these narratives is the correct one?
Yeah, clearly the equity market is looking past this slowdown in the labor market and seeing better days ahead in 2026. And then, of course, you have the AI investment, which is going to continue, and that's not really a bond story. We'll see if that continues to keep the equity party going. But boy, it's been quite a year, up 13% total return on the S&P 500 now. over 9% just in the last 3 months. We've actually gotten even better returns lately out of emerging markets. The emerging market index up 11%, a little more than that in the last 3 months. I think that jumps out at you. We've talked about China. Uh, you do have a really strong rally in Hong Kong, close enough to China, right? Even though the Chinese A share market didn't have as strong of a week. So, latest thoughts on emerging here, Kristian? It's been quite a rally.
Yeah, I mean, I think particularly you got Japan, Korea, and Taiwan. They're all making new all-time highs last week.
Mhm.
So, and then you got China kind of threatening to, some major breakouts as well. I think that's really the story. Maybe, we had the administration meeting with the Chinese on trade talks over the weekend and currently going on in Spain. And some positives coming out of there. I think that's really kind of what's driving this. China's such a big uh, part of the EM indexes that they were kind of to start the year. No one really thought that we'd see this type of rally coming out of China. So I think that's kind of spurring this momentum across the board in EM. I think.
Yeah, it's hard for me to for my teenage girls to listen to me, but when I inform them that it looks like TikTok is going to remain in operation in the US, I think they'll listen, and they may actually like their dad here for at least for a few minutes. So I'll look forward to that after I confirm that news is indeed true. Uh, so thanks for that, Kristian. We'll keep watching emerging markets. The bond market loved what it saw last week. I mean, this dovetails with your comments about the weakening employment picture. So fair to say that the bond market is pricing in a little bit more equity weakness or economic weakness rather. We have a 0.4% 5-day return in the ag, the broad bond market index, and look at that year-to-date return, 6.4%.
Yeah.
I haven't gone back and looked, but it's probably one of the best year-to-date returns at this point in the year that we have seen in a long time.
Yeah. Bonds doing what they're supposed to be doing. I think ahead of a potential slowdown. But I think last week, really it was about the inflation coming in line, didn't get a big surprise, but then you had those claims numbers. Some people saying there might have been an anomaly to that, but worst claims numbers since 2021. So that kind of just continued to fuel this rates lower trade. I think I think what it did is it kind of took out the potential for maybe a Fed that does a hawkish cut. I think that's still a risk, but a lot less than it was, and kind of opens the door to 3 cuts all in before the end of the year, and then a few more in the next year. And I think that's kind of gave the green light that data last week. So I think that's really the story when it comes to the bond market. We'll talk about the long end here in a little bit, which is a little bit different, but I think kind of short term of the belly. Um, kind of the data we got last week was almost a perfect storm.
Yeah, and then you have industrial metals with a nice move last week. So there's a positive economic signal there. I think we don't want too much inflation, but certainly that is an economic signal. And I didn't mention on the last page, but we have a period of outperformance, cyclical sectors versus defensive sectors. That's not new. That's been going on for several months now, certainly off the April lows. But those are two good signals from the equity market. They could be wrong, but they're good signals that this market can keep going higher and that the economy will hold up. So last thing here, the dollar, Kristian, is still bouncing around those key technical levels around 97. We're just kind of waiting and seeing on that.
Yeah, well, I mean, going back to the commodity thing real quick, I would say pick your poison, because lumber, which is another one of these kind of leading indicators, is not doing well at all. So I think it kind of depends. It kind of depends on what you're looking at. Um, In terms of the dollar, yeah, I mean, not much of anything, right? It's volatility is incredibly compressed, and we talked about that on our Thursday call, just how compressed kind of FX volatility is at the moment. So I think it's waiting for signaling whether it's going to be the Fed meeting on Wednesday or what have you. The ECB last week was absolutely boring for the FX market. Didn't really react because that came in pretty much what everyone thought Lagarde would say. So I think really it's just a market in need of a catalyst. Um, on the flip side, kind of to your point, Bookie, kind of the Aussie dollar is considered kind of one of the more pro-growth currencies out there. It traded at new highs last week, so maybe that's kind of confirming what we're seeing in the industrial metals. Um, something to watch, but I think, until you start seeing kind of moves in the euro and some of the other bigger currencies, and in that level that we've highlighted a lot, right around 96 in the dollar index, incredibly important. If that were to break meaningfully, I think that sets up a potential, rotation across markets. You start getting kind of that signal that the dollar is starting another leg down, versus if it can hold here and maybe get back above 100, 103 of those areas, then you might see people starting to warm up to the to a bullish dollar trade as well.
Yeah, I just talked to somebody who's planning some European travel, so they're certainly watching that closely. I'll also point out the Chinese data over the weekend was weak, and so I'm sure tariffs are part of the story there. That could cause the Aussie dollar to maybe struggle a little bit here in the next couple of days. We'll see. Uh, let's turn to the S&P 500 chart. So, I watched the RSI 14 pretty carefully as a measure of how overbought we are, and we're not quite overbought, but really close to it. I guess today's gains, if they hold, will push us over that 70 break point, and so this would be a logical place for the market to take a little bit of a breather. We're over 6,600 now in the S&P 500. Few thought we'd be here. Certainly when the year started, really strong chart up and to the right. All these moving averages are moving higher. We're, of course, if you're at all-time highs, you're going to be above your moving averages. I mean, what do you think, Kristian? What kind of slows this down? Is it positioning? We run out of buyers? Is it something else from a technical perspective?
Yeah, I mean, listen, trees don't go to the sky, right? So it's one of these things you start to get, overbought, which I think we're starting to, if you look at things outside of RSI, you can make the case that we're starting to get there. What more concerns me when you look at that RSI, for example, is that we're diverging, right? We're not making new highs in it. So, the classic technician through their lens would say, that's a potential warning sign. But I think it's just, yeah, we've gone up, almost what, 40% in 5 months, right? Like that is unusual. Um, like I was looking at a chart where the last 100 days are almost without parallel in terms of the amount that the markets rallied versus the volatility we've experienced to get these types of returns. So I think all these things just, you know, listen, in the end, I tend to have a trend follower bias. So until things turn, for me, it's been those highs from February. That's really kind of the big level that if you were to see that break, that maybe turns the technical picture negative. We're a long ways away from there. So for me, it's really until you start seeing kind of the chart start to confirm maybe some bigger weakness, which we're nowhere near, that's when you worry about it. So for now, it's just kind of, let the trend play out, and just keep a close eye on it because I think we are starting to get to overbought levels, and if we do get a correction, we'll see how far it can go. But until we were to break down under those Feb highs, it's really hard to look at this chart and get that negative on it.
Yeah, I agree. We'll wait until the technicals send us a signal that we need to be more cautious. But at LPL Research, we continue to recommend fully invested equity positions tactically and strategically, but certainly tactically, that's the bigger news. So let's move on to the, I guess, headliner this week. If you could call the Fed the headliner, but I think the headliner is the weekly market commentary. And here we talk about how political uncertainty is influencing the debt markets. Normally, Kristian, I would say that the international debt markets aren't that important to domestic investors, even if they have fixed income exposure. But I think this environment, these international markets take on greater importance because of the relationship with US Treasuries and how important US Treasury yields are right now. So with that as a setup, we got three charts here, or four charts actually. Three from the weekly commentary, which you can find on LPL.com. The first one is the levels of developed market debt as a percentage of GDP. Some of you may be surprised at how high Japan is, but certainly we also can see that France and the UK are quite high as well.
Yeah. But I mean, I'd say listen, it is important because everything's interconnected these days, right? In the global economy, these global markets. So Lawrence and I, who kind of teamed up to write this piece, want to just kind of dive a little deeper and kind of explain, some of the things going on there and why it's important, right? But yeah, with this chart, U.S. debt and deficit spending levels usually dominate the headlines, but I think it's worth zooming in to see how other major economies are managing kind of their fiscal health. And as the chart shows, they're high, right? Which raises important questions about just long-term sustainability and policy flexibility and those types of things. But yeah, Japan holds, I would argue the most precarious position with debt nearing 235% of GDP. Now that number is quite a bit overstated, I would say, because of the gigantic role that the Bank of Japan plays in the bond market there. But even when you adjust it for the Bank of Japan's bond holdings, the number only drops to 134%. So still a very heavy burden, no matter how you cut it. I'd also say, kind of what caused this, decades of stagnation and repeated kind of government interventions. You could say that's related to financial crises, natural disasters, the pandemic, but all those things have kind of worked in tandem to push debt levels to these heights, right? And projections suggest that Japan's gross debt ratio is going to stay near 250% through 2029, so making fiscal consolidation a very difficult thing to achieve there. The U.S. faces a different, but I'd say equally serious challenge. We've got $37 trillion in debt, about 30% of global government debt. And the U.S. GDP ratio sits right now at about 122%. And this has been driven, by military spending, tax cuts, pandemic relief, and just underfunded entitlements. And it's on track for the largest debt increase among the G7 over the next 5 years. I would argue, given the dollar's reserve currency status, offers some financing leeway that maybe some other countries don't have. So, I'd argue maybe not as a challenging situation as some of the other countries, which we'll kind of get into. France also under quite a bit of strain with a debt at 116% of GDP, and it's among the Eurozone's most indebted countries. 3.2% increase in 2024, and deficits near 6% suggest rising fiscal pressure and limited room for maneuver, especially given the political situation that's going on there. The UK, they crossed an 100% debt to GDP threshold. That was its highest level since the 60s. This too, largely due to pandemic borrowing. And I think the post-Brexit environment there also adds a lot of complexity to just the fiscal coordination and economic management of it. And lastly, Germany stands out on the chart for its relative stability. Debt's only at 65% of GDP, and despite adding about 57 billion euros in 2024, strong growth there helped reduce its debt ratio. And I think it's an example of how important economic expansion really is to offsetting kind of borrowing concerns. But all in all, just want to highlight these divergent paths kind of reflect different policy choices and structural pressures. And with global rates kind of elevated, the cost of servicing this debt are starting to rise, which potentially limits governments' ability to respond to future shocks. And really just how these economies manage their debt. It's going to shape global financial stability, long-term growth, and just the general path of global bond markets going forward over the next few years.
Yeah, you can argue we're going to have many years of digesting this in the U.S. And in Europe. I think the Germany situation is really interesting because of they changed the laws over there and they can now borrow more, infrastructure spending, defense spending. So that number is going to go up. What's interesting in the U.S. is the tariff revenue is offsetting, or at least that's the Trump administration's plan, to offset the increased debt. We'll see if that comes through. Of course, there's legal challenges to the tariffs. Those will probably come regardless of what we hear from the Supreme Court. But it might be hard for them to fully offset that. So we'll just keep following that closely. And certainly the cost of financing is is just as important as how, or more important potentially to as how much debt that these countries have. So the U.S. Treasury is going to continue to focus on keeping long-term rates down. So let's focus in on France here for this next chart, Kristian. This is an eye opener. Tells us maybe will we be better off in France not working?
That's one way to look at it. Um, yeah, I wanted to show this chart just because I think France really is emblematic of the problem, right? France was actually downgraded over the weekend. Markets, not reacting much, largely because this move, I think, was somewhat anticipated. That said, the downgrade serves as, I think, a reminder of just deeper, more persistent challenges that all these countries are facing. While the immediate impact may be muted, the underlying issues, particularly around entitlement spending and fiscal sustainability, are far from unique to France. France is a prime example of just these structural pressures that all a lot of developed economies, I should say, are kind of grappling with, but kind of, generous social programs, aging populations, and just limited political appetite for reform have created kind of what I'd say are these long-term fiscal strains that are just increasingly becoming difficult to ignore. And, these dynamics aren't just domestic, they're beginning to influence kind of the whole point we're talking about this is global bond markets, especially as you're starting to see investors kind of reassess sovereign risk in light of kind of all these rising debt levels and just general political uncertainty across so many big countries. So I would say while this downgrade might not be a shock, it does add to this kind of growing narrative that structural fiscal challenges, especially those kind of tied to entitlements, are becoming a bigger concern for the bond market. And France's situation is just emblematic of this broader trend, and it's one that's I think going to continue to shape investor behavior and just general yield curve dynamics in the years to come.
Yeah, it's clear from many of these countries that cutting spending is not the way to get reelected or stay in office. We certainly know that in the U.S. It's going to continue to be a struggle going forward. So you gave me a nice segue, Kristian, to this chart, although I didn't take it and I waited. The long bonds in these markets, these sort of fiscally challenged markets, those have sold off quite a bit. I mean, it's been trending higher for the last several years, but we've seen this increase kind of accelerate in recent months.
Yeah, I mean, this chart really just shows how, political instability and really rising fiscal spending are starting to impact the shape of global yield curves. It shows investors are just increasingly asking or needing higher term premiums to hold long dated government debt, and particularly in countries where there is political uncertainty, because that, threatens fiscal discipline and economic stability. And term premiums really are just, essentially you can think of it as the extra yield investors need to lock up their money in longer term bonds. So, and that kind of, I think for years, these premiums were negative in many developed markets, but that's clearly changing. And I think that's just concerns around government, as concerns around governance risk start to grow here, yield curves are going to steepen, and a sign that and just kind of signal to us that investors are reassessing kind of these long-term risks. This year, while short and intermediate term bond yields have generally declined, uh, you can see 30-year yields have either risen or held pretty steady, even in the U.S. where we haven't seen shorter maturities. They've basically been falling, so that's pushed yield curves to their steepest levels in years. Um, and I'd say, inflation, central bank policy still obviously plays a major role in shaping yields, but the steepening, kind of suggests to be prepared for a kind of a new and growing influence in markets, and that's going to be the political risk. So we're seeing this kind of play out already in Europe and Japan. We saw last week the prime ministers there both step down. That obviously adds a little bit of investor uncertainty, and these kind of disruptions can raise just questions about future fiscal policy, especially when you've got countries that are facing kind of budgetary pressures already. So I think if this political instability kind of continues to rise along, with higher spending, investors may start to keep demanding kind of more compensation really to hold longer term debt, which could keep yields higher even if inflation starts to cool or central banks ease. And I think just it's a dynamic that you got to be watching closely as it adds just a new layer of complexity to the global bond markets in general, right?
Yeah. Why wouldn't you look at a shorter term yield? Do you want to try to take the central bank noise out? So this is 5 year, 30 year. Are you trying to isolate longer term factors here?
Yeah, I think especially within the in the US, right, we've seen kind of this, like we talked about at the beginning of the call, what's going on with kind of this semi-growth scare, kind of with the move going on with the move lowers in employment. So really just kind of just trying to isolate that out from those dynamics and just showing kind of less that and really kind of just want to highlight what kind of where we're seeing the steepening, particularly at the long end of the curve, where you'd expect in a normal world that given all that we've been seeing that long end bond yields to be coming in a little bit. And the fact that they're going up just tells you there's a bit of concern in the markets just about all the things that we're talking about with regards to the fiscal situations across all these countries.
Makes sense. Yeah, it really, if you can isolate the political aspect of this and long-term structural challenges, you can really see that this stuff it matters. So this is it's not just yields, right? This chart, it's I guess, effective yields X currency. Is that the right way to look at this, Kristian? You're saying that the international investor would have to hedge currency to get these yields?
Yeah, it's looking at it in terms of hedging costs factored in, right? So hedging costs really just the interest rate differential, for whatever tenor that you're hedging an instrument factored in. Um, that's really what we're kind of showing here because most kind of big players in the market, call them institutional, like insurance companies, whatever, they tend to, when they buy foreign bonds, they tend to hedge, right? A significant amount of that. Like it's a yield play, not a bet on the currency. So you tend to see these investors hedge, right? So really what we wanted to show here. So if you look at like longer term yields on UK gilts, on JGBs, on German boons, they're all at or right around multi-year highs. Um, and you start to see better returns now available there or outside the U.S. and foreign investors who hold about I think around 30% of the treasury market. We're kind of saying that they may start becoming less inclined to buy treasuries, or at least as much as they have in the past. And really in the chart we're kind of highlighting that rising home market yields and higher currency hedging costs are making U.S. Treasuries just less attractive for European and Japanese investors. The yield gap between 10-year treasuries and boons or JGBs has narrowed quite a bit. And after hedging, treasuries are often yielding less than the local alternatives, which really hasn't been the case for much of the past decade. And if foreign demand fades, while U.S. Treasury issuance stays high, then yields may need to remain elevated in order to entice domestic buyers, to buy those treasuries. So that said, yields are really driven by growth and inflation expectations. But with the Fed kind of expected to cut rates this week, amid the softer labor market we've talked about, we may be past cycle peak here. On the plus side, recent auctions have been showing pretty strong demand with record end user participation. And I think that's a sign that investors maybe want to start locking in current yields. But again, with rising debt levels and little appetite for fiscal restraint across all these countries, long-term yields may need to stay higher. And because of all this, we're basically neutral on duration, see kind of the best risk reward in the 2 to 5 year part of the curve when it comes to the U.S. at least.
Yeah, this is why, or one of the big reasons why we don't think the 10-year yield goes below four. I mean,
Yep.
it may go a little below four in the short term, but we really see the yield kind of fair value as 4 to 4.5 still, with all these debt and deficit concerns. Actually, Lawrence, our fixed income strategist, Lawrence Gillum, wrote about this in the mid-year outlook, right? That it's a tug of war between essentially economic growth and inflation, so domestic economy, and then the long-term debt and deficit concerns. Right now, the economy slowing is winning. and yields have come down, but we're not so sure that that goes too much further. Another factor keeping rates down is the
We
Fed.
thought it's where we thought we the risk was too in the mid-year outlook. Like we've got this kind
Oh
of
yeah,
push-pull
absolutely.
dynamic, but that whoever wins probably in the second half will probably be bond yields going lower, which seems to be materializing.
Yeah, absolutely. I mean, 10-year yield at like 403 last check, so this is a very close to a three handle, which will get a lot of attention. So the big event of the week, of course, is the Fed meeting. Actually, the BOE, the BOJ, and the BOE meet this week as well, I believe. So Fed funds markets pricing in, I think, like an 81% chance of three cuts this year. I mean, we've been sort of, I don't know, maybe a coin flip between two and three. So, Kristian, what do you think we hear from the Fed? Do you think they're, dovish with their cut? Where do you sit?
Yeah, and I agree. I think it's definitely the biggest event risk for the week. I mean, I think markets will be closely watching how Powell navigates, I think, what's become a pretty tricky policy moment. While a few voices are still calling for even 50 basis point cut, I think the outcome feels a little stretched, just given the current data and the tone of recent Fed communications. I think the risk is we get a hawkish cut. And that is the Fed could lower rates, but signaling caution about future easing. If Powell delivers a message that's non-committal or leans toward a more data-dependent stance, it could prompt markets to maybe reprice expectations for the rest of the year. Right now, futures still imply about three cuts before the end of the year. So a more, call it restrained tone from Powell could chip away at that pricing. But that said, even if Powell does dial back expectations, it's just unlikely to trigger a major market correction on its own. And I think that's because investors are already factoring in kind of the broader context here, and that means that we're getting a new Fed chair soon, right? And that adds kind of another layer of uncertainty, but also I think tempers any reactions to short-term guidance is not as dovish as maybe the market's leaning right now.
Yeah, we're kind of used to the market swinging around. It's Fed rate cut expectations. That's been happening for a couple of years now. We'll see if they get it right here, but it looks, I mean, certainly as you get closer to the end of the year, you're going to get it right for 2025. The Fed funds market, we're showing implied rate cuts here. The red dotted line is three cuts. So we're not quite there by December, but fairly close. And then if you go further out into 2026, you actually get to about five and a half cuts. So we'll be watching the dot plots and the messaging from the Fed to see if maybe that pricing changes. That's a pretty good bond market environment if we do get five and a half or between five and six cuts, because then you're talking about maybe even under 3% on Fed funds. And if you get under 3% on Fed funds, there's a decent chance, as long as the economy is not collapsing, there's a decent chance that you have a little bit below 4% on the 10-year, given our expectations for the shape of the yield curve in the US. So this will be a big one. They're always big, but I think this will be especially big given all the changes at the Fed and the anticipation of markets. So anything else you're watching here this week, Kristian? Thoughts on retail sales or any of this other data? I mean, I guess claims matters after the spike last week.
Yeah, for short claims, I think people are going to want to see whether that Texas aspect was the anomaly that caused it or not. But I think honestly, the other big event is what's happening now with the Chinese meeting some U.S. officials in Spain, right? So we were to get anything more concrete out of that, that has the chance to move markets. That's kind of what I'm looking at here. It seems like we're setting up for a potential Trump Xi summit here in October. So I'd expect anything that leads us to that, it's going to come out here in the next few hours or what have you.
Yeah, just the lack of let's call it escalating tensions in China is a win. And if the two sides are talking, I think the market's gonna like that, both in terms of Asian markets and in US markets. So good call out there, Kristian. Certainly trade talks continue, and we'll have to, even though we all want the tariff story to kind of go on the back burner, that's not going to happen for at least a few more months. So we'll end there. Thanks, Kristian, for joining and walking through why the international bond markets actually matter for U.S. investors. It's because they put upward pressure on our treasuries and certainly highlight the need for fiscal restraint. We're not really getting it now, but at some point we're going to need it. On that cheery note, I mean, it's a bond market call, right? So we don't have to be cheery. But on that note, we'll wrap up. Thanks, Kristian, for joining. Everybody, thank you for listening to another LPL Market Signals. We will be back with you next week. Take care, everyone.
See you later.